The Wall Street crash of 1929 is said to be the beginning of the Great Depression in the U.S. The stock market crash can be partly blamed on speculation. Investors speculated wildly and bought stocks on margin or borrowed money. This led to very high stock prices. So when the stock market faltered before the crash, investors had to sell off stocks, losing $16 billion in October 1929 alone. 25% of the United States was unemployed at its highest. This was 15 million unemployed Americans. Due to bank failures, trade levels, such as export of goods, jobs, and personal income plummeted throughout America. Construction came to a standstill, and farmers had a difficult time as commodity prices bottomed out. Canada's unemployment rate was even higher at 30%. The Depression hit hardest the nations that were indebted to the U.S., like Germany and Great Britain. In Germany, unemployment rose sharply to 25% of the workforce. President Herbert Hoover tried to fight the Great Depression by increasing the deficit spending by $3 billion a year, but he was unsuccessful. When Franklin Roosevelt took office in 1933, he acted swiftly to stabilize the economy. He instituted a series of programs and projects called the New Deal. They helped stabilize the economy and provide jobs and relief to those who were suffering. Because the Great Depression affected other countries, it led to the emergence of totalitarian political movements in Italy, Germany, Spain, and the Soviet Union. For example, Benito Mussolini became the first fascist dictator of Italy by harnessing the economic frustration of the Italian people. In short, when the Depression hit the U.S., the markets went down drastically. This distorted trade patterns of U.S. with every other country that it traded with. Exports reduced and imports reduced as well. You can imagine how it then affected other countries. So this led to changes in exchange rates, and other countries' currencies were negatively affected, and that had its own consequences.